Hello everyone and welcome to the last video that we have for the FM Pre-December 2025 mock exam. So with this video, we are coming towards the end of this mock where we are solving the second question, the second case study of section C. The name of the question is Greatrix company. So having a look at the first requirement, I can see that for 10 marks, I am supposed to calculate what? The equivalent annual cost of the 3-year and the 4-year replacement interval for the two machines, and I have to advise Greatrix company which machine to purchase. So different options are available. We can replace it after 3 years or after 4 years. So we are supposed to find out which will be the better choice for Greatrix company. Let's have a look at the scenario. Greatrix company is a small, recently incorporated entity that is finding it difficult to raise funds to replace a machine that is essential to its production process. The company has identified two machines of identical capacity but with different technology which is going to be suitable. Only one machine would be purchased in this mutually exclusive investment decision. Guys, what do we mean with mutually exclusive? Mutually exclusive means only one out of the two options is going to be chosen ahead. Machine 1, this machine is going to cost $1 million and would need replacing after every 3 years when its residual value is going to be $100,000. Annual operating costs are expected to be $150,000 in the first year of operations. This will increase by 5% per year in each subsequent year. Maintenance costs would be $32,000 per year in the first year. So again, guys, have a look here. They are telling you people again and again, this is the cost of the first year itself. This is something which we will take care of when we are doing our calculations. Increasing by 4% per year in each subsequent year. Then we have machines with, we have information with respect to machine 2 given to us. So what we can do is we can get started with our format workings. So what we are calculating over here is you can copy paste this portion from here to let the examiner know that this is what we are solving. The copy paste functionality does not seem to work, so we have no option but to type it out. So we'll say that here we are working around the EAC of the 3-year and 4-year replacement intervals for the two machines. So this is what I start off my answer with. Now I'm going to put in the numerical workings that I'm supposed to do. So first, let's calculate it for machine 1, which has a useful life of 3 years. Now what do? Is I will plot year 0, 1, 2 and 3, and then let's see what all information I'm supposed to put in. Firstly, I am being told about my initial investment. So I can plot in my initial investment, which is going to be $1 million. Then I will also be putting in the residual value also side by side. So I can plot the residual value over here. Residual value is given to me as $100,000, putting it as a positive figure because this means money coming in to me at the end of this particular year. Then I am supposed to take for the annual operating costs. Annual operating costs are given to me as $150,000 in the very first year. So I'll put in this annual operating costs. First year itself, they're telling me it's $150,000. So I will not be putting any extra inflation over here. I will start to apply for the inflation from the second year onwards. So second year onwards, I see that there's an inflation of 5%. So this figure into 1.05. And then for the third year, it'll again be 5% more compared to the previous year. So what I can do is I can use this figure into 1.05. So this is how I will be able to work around how much will be the cost that I incur over the operations. Then one more thing which I'm supposed to consider is about my maintenance cost. So I'll put that also. maintenance costs. Those are again given to me in first year terms at $32,000 per year. So negative 32,000. Now this is also increasing 4% per year. So what I'll do is equals to this figure into 1.04. And then for the third year, it will be this figure into 1.04. So this is how I have worked around how much will be the maintenance cost that I'll have to bear over this machine. Now what I can do is I can take for all of the net cash flows. So net cash flows that will be there because of it. In year 0, we can use the sum formula. So this formula will give me my net cash flows. This is what my cash flows will look like for all of these years. Now I know all of the cash flows that are going to be there with respect to machine 1. So now I can finally apply the NPV formula. The cost of capital, let me have a look at the last line. Greatrix company uses a discount rate of 12% to appraise the investment projects, and I'm supposed to ignore taxation. So now I will calculate the NPV. So equals NPV. From this figure, you will take 12% as the first discount rate. Now we start to discount the cash flows right from the first year onwards. So I select the first 3 cells and then subtracting the initial investment. Initial investment is already put in a minus sign. So that's why I'm putting a plus sign over here so that the net effect is subtraction. That means the NPV that I'm getting is something like this. But then I have to work around the equivalent annual cost. So for the equivalent annual cost, I need to have the annuity factor. So for that, I can go to the annuity tables, formula sheet. 12% is the cost of my capital. This is the table for 12%, and for a period of 3 years, 2.402. This is the annuity factor that I'm supposed to use. So this is going to be 2.402. Now, when I want to find out the EAC will be equal to this figure divided by the annuity factor. So this gives me an equivalent annual cost of $576,918. So this is what is my equivalent annual cost is going to look like. I can bold to show the examiner that this is my final answer. Now proceeding towards the calculation for the second machine, and then we'll do a comparison to give our final recommendation. So here talking about machine 2, with respect to machine 2, I can see that there's a replacement cycle of 4 years. So I will write that this is a 4 years replacement cycle. Machine 2 is going to cost us $1.25 million and would need replacing after 4 years, when its residual value is going to be $150,000. Annual operating costs expected to be $125,000 in the first year of operation. This will increase by 6% every year in the subsequent years. Maintenance costs are forecast to be $42,000 in the first year, increasing by 4% per year in each subsequent year. So what I can do is I can copy paste some of my workings. This is year 4. And then what I can do is I can plot in the numbers as per what I had calculated just above. I can put it over here. Initial investment, I'm supposed to take as a $12.5 million. So this is my initial investment. Residual value here now I'll get at the end of the 4th year. So that's given to me as $150,000 money coming in, hence putting it as a positive figure. Then plotting about the annual operating cost. So it's telling me it's going to be $125,000 in the first year of operations. So I I apply inflation to this figure itself, which will be at the rate of 6%. And then in the next year, it will be again at the rate of 6% inflated, and in the last year again 6% inflated. So this is how much my operating costs are going to look like over all of these years. Now the next thing which I'm supposed to take for is the maintenance cost. So they are telling me it's for the second machine it's $42,000 for the first year, so negative $42,000. And then what I can do is I'll just apply the inflation. So the inflation, it's telling me at the rate of 4%. So into 1.04. Same, you can copy paste here. So it'll automatically put the formula accordingly, and same you can copy paste over here. So this way you will be able to work around the maintenance costs. Now you can calculate the net cash flows. You can use the sum function to find out the net cash flows. Right. And now we can finally work around the NPV. So equals NPV, 12% is the rate of discount. Select all cash flows from the first year till the last year and then subtract your initial investment. Taking a plus sign again, telling people the reason why, because I've already taken the negative sign with my initial investment. If I put another negative here, it'll do the opposite. It'll add both of the numbers, which I do not want. So here, this is what the NPV is going to look like for the machine 2. Now here with machine 2, again going to the formula sheet, because now I want to go for the annuity factor for 4 years. So right, this is the formula sheet. 12%, 4 years, 3.037 is the annuity factor. 3.037. So now my equivalent annual cost will be NPV divided by the annuity factor, which gives me $560,149. So let's do a comparison. Which out of the two is going to be cheaper for the company? In machine 1, I spent this much amount of money, 576,000, or roughly you can say 577,000 every year. Here it is 560,000. So machine 2 is lower. So as a result, what recommendation will you write? Because you're supposed to give advice also. So the advice that you will write is that the 4-year replacement interval has the lowest EAC. So machine 2 should be purchased. So what I'll write over here is that the 4-year replacement cycle has the lowest EAC. As a result, or you could say, hence, machine 2 should be purchased. So this is how you will give the recommendation to earn that final 1 mark. All the calculations will total up for 9 marks. 1 mark is there for the recommendation. So if you only do the calculations and in a hurry you forget to write about the comment, about the advice, you will lose on 1 mark in total over here in this question, provided all of the other workings that you have done are absolutely correct. So ensure that you remember to answer the entire question in full. So this is the part A which we have answered. Now we will proceed to part B, where we have to discuss why the replacement interval decisions should be based upon equivalent annual cost and not the net present value. So here, when we are replacing something again and again, I need the same asset over and over again, which I will be replacing over different time frames. Now, if let's suppose it's a simple one-time thing which you're supposed to do, one-off project, then using the NPV is very easy. If it's a one-off project which has different lives, then the straightforward technique is going to be to use the NPV, find out the cost, find out the benefits, and then choose whichever is going to be more beneficial for the company. But when it comes to projects which we can repeat endlessly and they are a chain of infinite projects, then in that case, the situation gets a little bit more complicated and I can no longer simply use the NPV technique. So what do I do over here is, to answer this, I first work around the NPV. And now because these are different replacement intervals that we are talking about, one machine lasts for 3 years, another machine lasts for 4 years. So just comparing the NPV will not make sense because it will not be a like-to-like comparison. If I want it to be a fair comparison, I have to see how much will be the annual cost. So to reach to the annual cost, I have to calculate the EAC. So to allow for the different lengths that we have over the time which we will be getting the benefits, NPV is divided by the annuity factor so that we are able to find out the equivalent annual cost. What does the equivalent annual cost tell you? It tells you the cost payable at the end of the replacement cycle, which is equal to the NPV. So that means as a business, you know that every year, this is the amount of money which you have to pay to be able to use the asset which you want to. So this helps you to find out which asset will cost the least to the business, and this is how you choose that particular cycle, whether 3 years or 4 years. You choose as per whichever replacement cycle gives you the lowest possible equivalent annual cost. So we choose the replacement cycle which has the lowest equivalent annual cost. This is how you will be framing your answer for 4 marks that are available for this particular requirement. Now proceeding further to the last and the final requirement pertaining to this case study, which is part C, which wants you to explain possible reasons for the capital rationing experienced by Greatrix and suggest 3 ways that it may overcome this problem. So if you see, we are a small incorporated entity finding it difficult to raise the funds, and the company has identified 2 ways. Okay, so basically we are finding it difficult to raise the funds. That means from the outside I'm not able to get more money. That means out of the 2 types of capital rationing which you people would have studied, hard and soft capital rationing, I get to know that because this is external, this is hard capital rationing that I am facing. So Greatrix is a small company, and the hard capital rationing it is experiencing is a common problem which is usually faced by the SMEs, the small and medium enterprises, which we often call it as the funding gap. Now, what are a few reasons why they are facing a funding gap or why they are facing this problem? One reason is that the people are finding the company too risky to lend to. So maybe they are not able to get more debt, get more money, because the investors, the banks, are thinking that this company will be too risky. What could be another reason? Maybe Greatrix does not have many assets which they can give as a collateral for taking the loan, or whatever assets that they already have, they are used already as a security for any other loan. So it's a small company, may not be able to offer security for the new loans, as already they have been offered as the security on the other loans that the Greatrix company has taken. Another reason why they can find it hard could be because they have recently incorporated the company. That means I do not have any past credit history. So if the bank cannot see my past credit history, again, how will they decide whether I am even worthy of giving the loan or not? Another reason could be some government imposed restrictions. So maybe the country where Greatrix is operating, maybe the government has imposed some sort of restrictions on banks to lend the money to certain industries, or in general also if the economy is not in a good state, then the government is probably going to impose some restrictions over the lending. Now, these were a few reasons why they are facing this particular problem. Now we will suggest 3 solutions. What are the 3 ways in which this problem can actually be solved? So the very first solution which is available for the SMEs, as we've studied the solutions also for the SMEs, first is the business angel financing. So Greatrix company can consider going to these wealthy investors who invest directly into the company, which are willing to take higher risks in the hope of getting higher returns. Another solution is that they can go for crowdfunding. Usually crowdfunding is used for entrepreneurial ventures, but crowdfunding is where many investors will come together on a platform and invest money in a particular company to finance a particular venture. Then another solution which they can possibly use is a government aid or grant. So when we were covering the concepts, we've also studied how SMEs are also helped by the governments. Governments usually give them aids or grants which can be linked to a specific business. Maybe the government wants to boost some sort of industries, or if the government wants to boost some specific areas of the economy, some areas where development is not so much there, which are backward areas of the country. So if the government wants those areas to grow, then the government does offer some subsidies, some grants, some aids to those businesses who set up their work over there in that particular remote area which the government wants to develop. So these are a few solutions which are possible for Greatrix company. Also notice one thing, guys, time and again you will see that in my answers I am using the name of the question, that's Greatrix, because the requirement uses specifically Greatrix name for me to find out that the examiner is not looking for any general answers. They are looking for tailor-made answers which specifically suit the case study of Greatrix company. So ensure that you do not end up writing generic answers here. Generic answers will not be able to earn a lot of credit over here. So ensure that you're also using the name of the company in your answer as much as possible if it is such requirement where you're supposed to link it to the scenario. So this was the Greatrix company question. With this, we have finally come to an end to solving the FM Pre-December 2025 mock exam step by step together. I really hope that these videos were helpful to you, and I wish you all the very best for your final exams. Do let us know how it went. Bye-bye.